Assalamu alaikum. Assalamu alaikum. Can you hear my voice?
Yes, we could
Wa
hear you.
alaikum salam. Yes,
Salam,
I
brother.
can.
Yeah. Can I share screen?
Okay.
Can you see the screen?
Yes, we could see
Yes.
you, bro.
All right. Bismillah ar-Rahman ar-Rahim. First of all, thank you to the organizers for inviting me to this August forum. And I listened to the earlier presentation. It was very informative. My topic is going to be about how to strengthen Islamic banking in COVID-19 era. I am speaking from Pakistan. I teach here, and as you have already mentioned, that I did my PhD in economics from UKM, Malaysia. So this is going to be my presentation outline. First of all, I would discuss that what are the specific challenges for Islamic banks to operate in COVID-19 era and beyond. And then I would discuss that what is the response by the Islamic banks to these challenges. And then what is the value addition in the response in Islamic finance, especially with regards to Islamic social finance. And then I would also discuss that COVID-19 started in 2019, and then we saw certain developments, and then we saw economic and financial recovery. So I would also talk about that what is the kind of recovery, what is the extent of the recovery, which sectors have performed well, which sectors are still struggling. And I would discuss all of that with some empirical evidence, which would be suggesting that Islamic finance and Islamic banks in particular are showing stability and are showing signs of recovery, which is a positive thing going forward. And then we can have some question as well. So first of all, I would discuss that what are the specific challenges for Islamic banks in COVID-19 era. The first challenge that comes is that we know that in a lot of Muslim majority countries where Islamic banking is being practiced, the predominant use of the mode of Murabaha Mu'ajjal is there. The predominant mode of financing is Murabaha Mu'ajjal. And the problem in that particular mode of financing is that once you price the asset, you cannot reprice it. You cannot reprice it. So if that is not possible, then what happens is that if, let's say, the client who is provided with asset-backed financing is not able to pay on time, if he or she is not able to pay on time, then we cannot reprice as per the rules of Murabaha Mu'ajjal. So this is one important challenge which Islamic banks face. Conventional banks are easily able to roll over the loans. They are able to reschedule the loans. They can reprice their products. But in Murabaha Mu'ajjal, once the Murabaha price is agreed upon, it cannot be changed just because of rescheduling of cash flows. So if that cannot be done, then Islamic bank would be at a disadvantage as compared to conventional banks. So this was the first challenge which came across for Islamic banks. Another challenge is that if, let's say, we use fixed rate contracts, then there is a rate of return risk. We know that before COVID-19, the interest rates or the benchmark rates were quite high in some countries, as high as 4% or 5%. But when COVID-19 happened, then what happened was that the governments decreased the interest rates. So the benchmark rates got decreased, and they went down to as low as 0.5% somewhere, 1% somewhere. So what happens is that if we are using fixed rate contract and the contract is going beyond COVID-19 and which started before COVID-19, so the pricing would be different, and during COVID-19 and after COVID-19, the pricing would be different. So this is rate of return risk in fixed rate contracts, and this is another challenge for Islamic banks. Another challenge is that when financial crisis happens or economic crisis happens, the firms are looking for distress financing. They are not looking for expansion. Not many firms are looking to expand their operations. They are looking to manage their finances. They are looking for distress financing. When it comes to distress financing, we have limited solutions. So if a firm is looking for expansion and needs financing for building infrastructure, we have products, we have solutions. But when it comes to distress financing, where money is required not to buy an asset, but to manage different liabilities, different commitments, different working capital requirements, so there are limited solutions. Likewise, there are limited solutions for working capital finance. So when we talk about money required to pay wages, money required to pay utility bills, money required to pay uh, previous liabilities, there are limited solutions that we have in Islamic finance as compared to the conventional banks. Another important challenge or risk is potential increase in defaults. We know that Islamic banks, by and large, are more stable than conventional banks in many jurisdictions. But when the economic crisis happens, when financial crisis happens, then the clients who are being provided with finance by Islamic banks, they have decrease in their ability to repay their debts, their obligations. So if they default, then this can increase the non-performing loans for Islamic banks. Another important challenge is that Islamic banks cannot roll over the debt. They cannot easily roll over or reschedule the debt, and they cannot have compensation for every loss of opportunity cost. Conventional banks can easily say that if they are having an opportunity cost loss, they would be compensating it in the pricing. But in Islamic finance, there are certain contracts in which repricing is not possible, and the Islamic bank cannot claim all the lost opportunity cost. So these are different challenges that we come across for Islamic banks as they are operating in COVID-19 era. Now, if we look at the Islamic economics framework, we see that it's very stable and it's directly linked with the real economy. So before I come to discuss the response to the challenge by Islamic banks, I would like to briefly touch upon this Islamic economics framework. We know that when we talk about the circular flow of economy in the conventional space, we have households, we have firms, we have two markets. One is the resource market, the other is the goods market. In Islamic economics framework, we also have these players. We have households, we have firms, we have government, and we have these two markets, which is the resources market and the goods market. Now, the difference in Islamic economics framework is that here in Islamic economics framework, if let's say finance is required to purchase consumer durables, if consumer finance is required, then we have Islamic banks who would be providing asset-backed financing to facilitate purchase of durable goods in the goods market. So households who are not having sufficient purchasing power to purchase expensive durable goods, they can get financing from Islamic banks regarding those products. So Islamic banks are facilitating the sale and purchase in the goods market, and they are facilitating both the firms and the households. They are facilitating firms to increase their revenues, increase their sales, and they are enabling the households to increase their purchasing power so as to be able to purchase the durable goods which they cannot manage to buy with their own sum of money in the cash market or in the spot market. Likewise, in the resources market, we have Islamic banks which provide financing to the firms. These financing is provided through different trade-based contracts and also lease-based contracts. So firms need capital goods from the resources market, and sometimes they do not have enough resources to purchase all the capital goods, all the infrastructure. So Islamic banks are facilitating the surplus units households who have surplus savings. Islamic banks facilitate them to invest in the real economy, and they provide the deposits mobilized to the firms in the form of providing them asset-backed financing using the trade-based and lease-based modes of financing. So in this economic framework, what we see is that there is a very clear link of the Islamic bank with the real economy. It is facilitating the buying and selling of goods in the goods market as well as in the resources market. And it is doing all the other important functions which conventional banks do, which is to minimize the transaction cost, which is to do delegated monitoring on the behalf of surplus units who are putting their deposits in Islamic banks. And they are also providing efficient intermediation services, and they are also discouraging the flow of money just within the money market, just within the financial market. They are putting the money out in the real economy so that economic transactions happen, employment is created, and through the production of more assets, the GDP also increases. Now we come to the specific solution toolbox of Islamic banks to face the challenges of COVID-19 era. First of all, when we talk about working capital finance, it's not true that Islamic banks do not have any solution. They have solutions like Salam and Istisna, in which there is no need for an asset to be involved for the purchase by the client. So in Murabaha and also in Ijara, the client has the need to acquire an asset. Whereas in Salam and Istisna, the client basically becomes the seller and sells the goods that he produces. So by using Salam and Istisna, what can happen is that the liquidity can be generated and it can be used by the client in a flexible way as compared to the mode of Murabaha and Ijara. In Murabaha and Ijara, it is required that you cannot use the funds other than for the purchase of specific assets for which the facility is provided. But in Salam and Istisna, because the client is selling something to the financial institution or the other client in the real economy, the money which is received from the selling of asset can be used flexibly to manage working capital and to manage liabilities and so on. So when it comes to working capital finance, Islamic banks basically have Salam and Istisna product. And also in some jurisdictions, they have a running Musharaka product, which is basically an alternative of running finance. And that also provides the firms an ability to use the funds flexibly without having to necessarily purchase a specific asset. Likewise, when it comes to balance sheet restructuring means that in a crisis-like situation, you might face this situation that you have a lot of fixed assets which are not being used productively. And what you would like to do is to retain the capacity of production, but changing the nature of your asset from fixed to current asset. Like for instance, using sale and lease back. So you have an equipment, you have a building, you want to use it, but you want to liquidate it to generate cash. So what you can use is you can use sale and lease back. Sale and lease back structure is very useful for distress financing and also for balance sheet restructuring. Likewise, Salam and Istisna can also be orders. We did not find that when COVID-19 happened, Islamic banks did not get any business. No, they were continuing to get business through different modes like Salam, Istisna, sale and lease back. Another important feature is that Islamic banks provide asset-backed financing. So when they provide asset-backed financing, the pricing of assets is also very important. Now, initially, we did see decline in asset prices, especially in the price of commodities when COVID-19 broke out. But there was a quick recovery in the price of commodities, in the price of real estate, in the price of assets which Islamic banks finance. So this did not result in a huge challenge for Islamic banks. Yes, for few months we saw that oil prices were on a decline. In fact, some oil future contracts were trading in negative for a brief period, but it did not last long. This recession in commodity pricing did not last long, and there was quick recovery in the price of real estate and commodities. Now, this bodes really well for Islamic banks, because when there is quick recovery in price of commodities which are being used as subject matter in the financing contracts, then Islamic banks are not at a risk. So they know that the asset prices are not decreasing, they are stabilizing, and they are increasing. So even if there is a default case, Islamic banks can quickly foreclose the asset and recover their investment through the liquidation of the asset. Another important feature is that Islamic banks do not have legal requirement to pay a fixed return to their depositors. At least theoretically speaking, they do not have this requirement to match the returns, which is the market required rate of return. They are not necessarily required to pay any fixed rate of return. Yes, for managing the commercial displacement risk, Islamic banks would not like to deviate too much from the market required rate of return, but they do not have any legal obligation as such to pay a fixed rate of return. So what happens is that even if there is, let's say, some trouble in their asset portfolio, some loans are defaulting, some clients are not able to pay on time, they are not obliged to pay a particular rate of return to their depositors. They can pass on the fluctuation in return to the depositors. Yes, they would not like to, for the other reason, which is commercial displacement risk. But at least in theory, they have this feature that they are having pure pass-through of returns without legal risk of need for matching returns. So this is one advantage which Islamic banks have and which conventional banks do not have. And another important feature is that even before COVID-19, there was relatively less non-performing loans in Islamic banks as compared to conventional banks all across the globe. So even if we look at different countries, we find that as against conventional banking, Islamic banks have lower non-performing loans even before COVID-19. And even after COVID-19, this ascendancy or this advantage is retained. The reason is asset-backed financing. The reason is strong credit worthiness check. The reason is that Islamic banks do not have unsecured ways of financing, like, for instance, personal loans or credit cards, where there is no security, no collateral. Even in consumer finance, when Islamic banks would provide financing, there would be some sort of asset involved. Now, if we look at the value-added response via Islamic social finance, we find that Islamic finance had much more to offer as compared to conventional finance or conventional economics. We saw very huge mobilization of charities. We saw huge crowdfunding campaigns. We saw increased mobilization and disbursement of zakat and sadaqah funds, which was unique to Islamic economics, and we did not have anything like that in conventional finance or in conventional economics. And I would particularly highlight the strong role played by Indonesia in innovating Islamic finance, in providing innovative solutions in Islamic finance through Waqf-linked sukuk. So they combined the institution of social finance, which is Waqf, with an Islamic capital market instrument, which is sukuk. So this was a very unique product, and Indonesia became the pioneer of that innovative idea, and they have come up with Waqf-linked cash Waqf-linked sukuk. So these are some of the responses that we saw in Islamic social finance, which were quite unique to Islamic economics, and we do not have anything like that in conventional finance or in conventional economics. So if we look at the response of Islamic finance, Islamic commercial banks, as well as Islamic social finance, we saw that Islamic finance had a lot to offer to meet the financial requirements in COVID-19 era. And they were not lagging behind, they were not struggling, they were facing challenges, but they did have enough in the solutions toolbox to come up with alternative ways to facilitate the same need and achieve need fulfillment. Now, if we look at the post COVID-19 scenario, what we see is that economies are recovering. In 2020, the economies were declining. Many countries reported negative GDP growth. But in 2021, everyone is upbeat. Every economy is recovering. And also, we are seeing that asset prices are recovering. So that is very important thing for Islamic banks, because they provide asset-backed financing, and when asset prices decline, then they are having trouble. If you look at the global financial crisis of 2007 and 2009, the crisis got deepened and crisis got severe because of the declining housing prices. So the price of subject matter is also very, very important in banking. So when asset prices are recovering, as we are seeing, Islamic banks are having a very positive outlook, because they provide asset-backed financing. And if asset prices are recovering, asset prices are increasing, and if asset prices are stable, then they do not have anything to worry about in terms of non-performing loans, because the asset prices are not declining, and people would not necessarily default on loans because of lower asset prices. What happened in global financial crisis 2007 to 2009 was that housing prices declined substantially. So even those people who were able to afford mortgages thought that why we should be keep paying installments for an asset whose price has declined by, let's say, 50%. So asset price recovery is very important for financial sector stability. Another important thing is that now we are having increased demand for financing, especially after the government's incentives to real sector encouraging investments, and that will bode really well for financing, because banks basically earn by providing financing, and the demand for financing would come when there are incentives to the firms to basically make investments in the real sector of the economy. Now, what is happening is that governments all over the world are providing monetary policy incentives by keeping the interest rate very low. They are providing fiscal incentives to give tax exemptions and also reducing the tax rates. So all of this is going to increase the investment, and when investment increases, banks get more business, and when they get more business, they are able to provide more financing. Then definitely they will be contributing to the real economic growth, as well as ensuring that they are earning enough returns for their shareholders and also for their depositors. If we look at the Sukuk market is very active in 2021 as compared to 2020. We are having Sukuk issuances in Malaysia, in Indonesia, and also in GCC countries, and also even in Africa. So now the Sukuk market is back, and we are seeing a strong recovery. If we look at capital markets, they are showing V-shaped recovery. V-shaped recovery is basically that initially we had a decline after COVID-19 broke out, but then there is a strong recovery as well. So the graph, if we see, of capital market indices looks like a V shape. So we are having a V-shaped recovery, and banking sector is also showing stability. I would like to show this table, which is showing statistics for Islamic banking up to fourth quarter of 2020, and the data is coming from some 15 OIC member countries where Islamic banking is very prominent. So what we see is that Islamic banks are showing stability. Even in the recent data, Islamic banks are showing stability. If you look at capital adequacy ratio, which is very important indicator of solvency, what we see is that in almost every country, in fact, in every country, the ratio is beyond 10%. The ratio is more than 10%, which is the required minimum according to Basel III. So all Islamic banks in all jurisdictions, according to this table, are able to meet not only the minimum solvency requirement in terms of capital adequacy ratio, but some of them are having very high capital adequacy ratio, like Bahrain, Bangladesh, Brunei, Egypt, Indonesia, Jordan. Kazakhstan, they are having close to 20% capital adequacy ratio, which shows that these banks are solvent, these banks are stable, these banks are not facing any crisis. And when we look at their operations, what we see is that gross non-performing financing is very low in Islamic banking. So in none of the country, this ratio is more than 10%. It means that if we are providing 100 loans or 100 financing contracts, not even 4 or 5 of these contracts are having any issue of non-performance. So the ratio is very low. In some countries, it is even less than 2%. In some countries, it is less than 5%. But all in all, what it shows is that Islamic banks are not facing a huge challenge when it comes to non-performing loans and when it comes to solvency. If we look at profitability indicators in almost every country, what we are seeing is that the return on asset is positive, return on equity is positive, except for one country, which is Oman, and they were facing economic problems even before COVID-19 as well. So that is not a surprise. But for every other country, what we are seeing is that all in all, Islamic banks are not having issues when it comes to profitability. Net margin is also very high. Cost to income ratio is also declining in Islamic banking, which is a very positive sign. So what happens is that when there is a new player in the industry, they would start earning revenues from very scratch. So revenues would start from zero, but cost would not start from zero. The fixed cost has to be invested into the business, and that has to be done even before any money is earned in terms of revenue. So initially, the startups, initially the new players in capital intensive businesses would have high cost to income ratio. But now in Islamic banking, what we are seeing is that cost to income ratio is declining, and it is even less than 50% in many of the countries. This table basically shows that Islamic banks are solvent. Islamic banks do not suffer from non-performing loans to a large extent, and they are reasonably profitable. They have high net profit margin, and they are also gaining efficiency in terms of decline in cost to income ratio. So this was about Islamic banking. What about Islamic capital markets? If we look at Islamic capital markets, what we see is that there is a strong recovery after COVID-19. So when COVID-19 broke out, definitely there was a very swift decline. You can see that the V-shaped recovery can be exhibited. There was a very swift decline initially in, let's say, periods of March 2020, April 2020, and May 2020. So during these 3 months, the capital market indices declined in almost every jurisdiction. If we take globally, if we take any region like ASEAN or South Asia or GCC, we saw this decline during these 3 months, March 2020 to May 2020. But after that, the recovery is not only very swift, it is stable and it is consistent. So after the decline, what we are seeing is that the graph is just showing increase and increase. And that is true not only for a particular region, but for developed markets, as well as GCC markets, as well as BRIC countries, which include Brazil, Russia, India, and China. So in emerging markets, in developed markets, in Europe, in S&P 500, what we are seeing is that the recovery is consistent, is stable, is swift, and we have already gone beyond the levels which we reached in pre-COVID-19 era. So in pre-COVID-19 era, the index level was much lower than what it is today. So the recovery is fast, recovery is swift, recovery is consistent, and it has pretty much neutralized the negative effects of COVID-19. If we look at, for instance, specific countries, let's say in GCC region, like for instance, Kuwait, Oman, UAE, Bahrain, Saudi Arabia, Qatar. Again, what we see is that there was a swift decline 22 May 2020, but then the recovery happened, and the recovery is quite swift. Other than in some countries, like for instance, Oman, which is still struggling economically due to other reasons as well. And it's not just Islamic banking which is having trouble there. And in Bahrain as well, we see that the recovery is there, but it's not as prominent or swift as compared to, let's say, Kuwait, as compared to UAE, as compared to Qatar. But all in all, we are seeing recovery in Islamic capital markets. If we look at specific sectoral indices like property indices and energy indices, infrastructure indices, health industry, as well as materials industry, energy sector. These sectors are very important for Islamic banking, because Islamic banking is basically focused on asset-backed financing, and these real sector of the economy, especially energy and infrastructure, these are very important, you can say, source of business for Islamic banks. So here we are seeing that the capital markets are showing recovery. And what it implies is that if, let's say, these indices are showing positive performance, what it indicates is that the firms which are making up these indices are having high expected profitability. And these firms are basically the main target market for Islamic banks. So if these firms have high expected profitability, Islamic banks are also expected to benefit from their growth, benefit from their high expected profitability to get more business, as well as earn revenues through asset-backed financing, which would facilitate their shareholders as well as depositors. If we look at the Sukuk market, we see that Sukuk market was more stable as compared to, let's say, stock market, and which is quite sensible, which is quite understandable, because Sukuk is a product which comes in fixed income, whereas when we talk about stocks, it comes in equity space. And we saw that historically there is high return on stocks as compared to fixed income securities. There is a risk premium involved, and due to which we see that in fixed income securities, we do not see much volatility. Yes, there was decline when there was crisis in March 2020 to May 2020 period, but it was not as drastic as compared to the stock market. And the recovery was also quite stable, quite consistent, and we see that there is much less volatility. And if you look at the graph, if we would be putting a long-term trend line, the long-term trend line is going to be upward sloping, and which shows that yes, there was a blip, there was a brief period when there was correction in the market, but all in all, we did not see much decline in Sukuk market, and now the market is stabilizing. And now we see that even countries from Africa, even countries from South Asia, even countries from GCC are coming into the Sukuk market. And Malaysia and Indonesia are already the pioneers. They are already leading the market. We are seeing that Indonesia is coming up with innovative Sukuk like cash work-based linked Sukuk, which is very innovative and which is very conducive in terms of leveraging both social finance as well as commercial finance to mobilize funds for social impact investments as well. So I would stop here. If you have any questions, we can take the questions and we can discuss further.
Thank you very much for the interesting sharing, Doctor. Now, if anyone has any question, but I see here in chat box from Iyas from Makassar, Prof. Iyas is from stay in another island, Prof. Yeah, we are in Java Island. He live in Sulawesi Island, so far from us now. Okay. Assalamualaikum. My name is Iyas. From Fose Stimbonya Makassar. May I ask to Mr. Salman Ahmed, my question is, how can the Salam and Istisna contract reach the micro and micro, small and medium enterprise community, and how in your area with Islamic finance can you withstand the challenge of COVID-19, especially in the lower middle class? Thank you for your presentation. Inshallah, make you always health and success for improvement of Islamic economics. That's a question, Doctor.
Yes, very good question. And it's a concern that we all have, which is that is Islamic finance or Islamic banking reaching everyone? Is it for everyone? When it comes to deposits, we say that it is for everyone. Even if you have a small amount of money, you can put your money into deposit account, and we can show that Islamic banking is for everyone. But when it comes to finance, Islamic banking is not reaching each and everyone. So when it comes to deposit mobilization, it is reaching each and everyone. It is taking deposits from even the poor people. But when it comes to financing, not many individuals, micro enterprises, and small and medium enterprises are able to get financing from Islamic banks. If I show statistics, around about 75% of the financing goes to the large corporations, and only the remaining 25% is distributed among the consumers. About 12 to 15% goes to the consumers, and those consumers are also basically living in urban areas. They are professionals, they are executives, and they have enough funds to basically buy durable consumer goods, like, for instance, cars or consumer electronics and so on. Only 10% is then remaining for Islamic microfinance, for SME finance, for agriculture finance. Now, when it comes to Salam, it's a very conducive product for agriculture finance. In fact, when we talk about the literature, most of the examples for the use of Salam is concerning agriculture. And in agriculture, what happens is that you have to, first of all, grow the crop, and then you can sell it. So Salam facilitates in a way that it allows you as a farmer to sell your crop, which is not existing, and you can get the money right away. You can get it at spot. The payment has to be at spot in the Salam contract. So this way, farmer is able to get the cash and manage the working capital, manage the requirement of funds to grow the crops. And then when the crops are grown, by the delivery date, it can provide delivery to the Islamic bank. So Salam is a very important contract, but what we are seeing is that we are using these contracts not productively as much as is required, as much as is expected in agriculture finance. Salam is now being used in currency market. We have currency Salam. So Salam has to be used more in sectors like agriculture, where you have small farmers, you have micro enterprises, and they really need finance. They cannot access capital markets. Definitely, they cannot access capital markets. So what they are banking on is Islamic microfinance or Islamic banks. And in the regions where Islamic microfinance is still not quite substantive, Islamic banks have to step in, and they have to provide Salam for agriculture. If we look at the actual performance, yes, there is much more that can be done. But in terms of potential, Salam product can be used for agriculture finance. Likewise, Istisna can be used to provide financing to artisans, to farmers, or to manufacturers who provide manufactured goods. So for instance, if someone is into making furnitures, someone is into making products that have to be, first of all, manufactured, and then they can be provided to the client in the market. So in such products, Istisna contract can be used. So solutions are there, products are there. The need is that Islamic banks have to show greater will and greater urgency to basically target broader clients, especially in the financing side. So when we talk about financial inclusion, we basically think about facilitating poor people to open bank account in Islamic bank. Now, that is facilitated because here the money is coming in. So when the money is coming in, you are happy and you are getting from everyone. But when poor people come to get money from banks, then banks do not facilitate each and everyone. So yes, much more needs to be done. But in terms of potential, the potential is there, the solution is there. We need to use it more, you can say, productively and expensively to create greater impact.
Okay, Doctor. So you mean that Salam could be used to solve the problem of the financing for the lower class, such as a farmer? You mean like that, Prof? Okay. The second, continue to another question from Muniati Aisyah. He asked, Murabaha dominates Islamic banks in Indonesia compared to Musyarakah Mudharabah because of the low risk. How about in Pakistan or Iraq? What is the main factor that could decrease the high risk in the musyarakah and mudorabah or other real sector financing, especially during today COVID-19 economic turmoil?
Yes, very good question. This is one concern that we see in literature, that we talk a lot about equity-based mode of financing, but we only talk about them. We do not practice them as such, especially in the financing side operations. We use mudaraba in deposit mobilization, but not in asset side operation, not in providing financing. Now, the professor who has asked this question has very rightly said that the reason is risk. The reason is risk. So Islamic banks basically serve risk covers depositors, and these depositors give more priority to the safety of capital as compared to the returns. Because if they were really return seeking, if they were risk neutral, then they would go to the capital market, they would go to the mutual fund, they would go to the currency market, and they would not be coming to bank for getting higher returns. So safety of capital is important to them, and then profit is a secondary thing for them. So what Islamic banks do is that they are managing deposits on their behalf. So what they try to do is they try to use those modes of financing which can provide them stable returns. Like for instance, rents in lease-based financing, or profit in murabaha-based financing, where the price is agreed upon even before the Islamic bank purchases the asset. Now, in Pakistan, what is happening is that murabaha was used predominantly, but after 2014 and 15, we came up with a new product which was running musharaka. And the idea was that what you can do is you can minimize the risk by deciding to share profit not at the net profit level, but let's say at a operating profit level or at a gross profit level. So what they came up with was that let's agree to the heads in cost accounts, which would be shared between bank and the client. So not every cost is going to be shared. So what would happen? The Islamic bank would not be having this problem that it would be sharing at net profit level, and net profit level can be positive, can be negative, but there is no company which is operating and which would have a negative gross profit. So most companies would have a positive operating profit, and all companies would have positive gross profit. So in running musharaka, first of all, they reduce the risk by deciding that which cost heads are going to be shared between bank and the client and which would not be shared. Another thing that they did was that they came up with tier-based profit sharing ratio. So they had a target profit rate in mind, and they made tier-based profit sharing ratio. So in the first year, most of the profit is going to go to the Islamic bank. And when the profit falls in the second year, most of the profit will go to the client. So this way, Islamic bank would be able to achieve the minimum target return that it wanted to have. And the client would also not be paying Islamic bank more than what it would pay to the conventional bank. So this product became very, very attractive to the clients, because clients require financing for all sorts of needs. So if we say that we only provide murabaha financing from which you can buy a particular asset, clients would say that we need money to pay wages, to pay utility bills, to pay our existing liabilities, to pay to our suppliers. So not all the times we are requiring an asset, not all the times we are expanding. So that is why running musharaka became very successful, because in equity financing, when you get investment in the form of equity, you can use it the way you like. You can use it any way you like. So it's a more flexible mode of financing. And because of these two features, that share some cost heads between bank and client and not all, the risk got minimized. And by sharing profit in tier-based profit sharing ratio, the commercial displacement risk was also minimized, that Islamic bank would get its target profit return, and the client would also not be paying more than what it would to the conventional bank. So that was the scenario in Pakistan. Yes. Any other uh, maybe speaker? Can you open the speaker?
Okay, sorry. Thank you, bro. You mean that musyarakah will reduce the risk for the Islamic banking transaction, right? So it is another question from Al-Mawardi. Is in all Pakistan banking use both musyarakah and mudharabah system?
Yes. So if let's say the question is about their use in financing side operations, then the answer is that yes, musharaka is used, but in a modified form. In a modified form. So they call it running musharaka, where they agree that certain costs are going to be shared in this musharaka and certain costs are not going to be shared. So when you are deducting from the revenues the cost, you cannot deduct all sorts of costs, only particular cost to which we agree, the client and bank agree. So this way they minimize the risk of loss, and then through profit sharing on tier based profit sharing, they were able to basically minimize the commercial displacement risk. So musharaka through these modifications is being used in Pakistan, running musharaka as well as diminishing musharaka, which is another form of musharaka, but little bit different from pure musharaka, which is equity financing contract. But when it comes to mudaraba's use is very limited, very limited. It is used only among the financial institutions. So financial institutions know each other and they know that they are having enough liquidity and they are not going anywhere. So one bank knows the other bank is not going to go anywhere. So they have trust among them. So in money market investments, mudaraba is used between financial institutions when they want to manage their liquidity. Let's say one bank has surplus liquidity, another bank has shortage of liquidity. So they sell and buy each other's asset portfolio, and then they earn the return based on that asset portfolio based on mudaraba contract. But when it comes to financing corporations, when it comes to financing SMEs, the use of mudaraba is very much limited. For the reason that in mudaraba, the rule is that all financial loss has to be borne by the rabul mal. So if Islamic bank becomes rabul mal, then basically it has to bear all the financial loss. It has the risk of bearing all the financial loss, and the client to which financing is provided does not have any commitment to basically share in loss. So in that case, Islamic Bank would feel that it is at a disadvantage, and because it is serving a client base which is risk averse, the depositors are not coming to Islamic Bank only for profit; they are coming for safety of capital first of all, and then profit is a secondary concern. So they would like Islamic banks to operate in a way and use those contracts which are much less risky, which would ensure capital protection with some stable returns. So musharaka is used with certain modifications, but mudaraba is not used.
Okay, thank you, Prof. Thank you very much for your sharing. As a token or appreciation for your time and your valuable contribution, may Allah bless you. Jazakumullah khairan kasiran. See you.
Ya, terima kasih. Jumpa lagi.